Thanks to our friends at the Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. A lot of investors out there are looking for stability right now, looking for less volatility in their stocks, looking for the ability to generate income that they can count on, dividends that can grow, businesses that are built for the long term. One right now that's really interesting to a lot of investors is Brookfield Infrastructure Partners. Brookfield Infrastructure stock is actually down about 20% right now. It's down more than the S&P 500 from the day of its high at this point. Reporting earnings this week, investors are probably wondering, is now a good time to buy Brookfield on the dip before it reports earnings? Or is it time to practice a little patience and wait and see what's going to happen? Or maybe, is there something the market knows, or are there problems with Brookfield with that great legacy of returns that we may not see that kind of thing going forward? I'm Jason Hall. This is The Smattering, and we're going to talk about Brookfield Infrastructure here. So again, I want to just quickly talk about its long-term history of generating returns. When we include the dividend, the stock's down about 8% year to date. If we just look at the price of the dividend, it's down, again, 19% from the high. It's down about 10% over the past, since the beginning of the year. Over the past 12 months, it's down about 7%. I want to look at a total return level compared to the S&P 500, because again, a big part of the value for owning Brookfield Infrastructure is that dividend. And once you start comparing it to the S&P, you see there's a reason people like to own this business over the long term. You look at the past 3 years, it's performed about as well as the S&P. Over the 5 years, starting to separate itself in terms of returns. Over the long term, again, 10 years since its IPO, has absolutely smashed the S&P 500. It's turned a $1,000 investment into over $10,000. It is a great, great long-term investment. All right, that's all good, right? If you've owned the stock, what's it going to do for you going forward? That's what everybody wants to know, I am sure. And part of the way that we can understand that, again, is how it's generated those long-term returns, that legacy of capital allocations. This is a top-tier capital allocating business. The businesses that they participate in, the infrastructure business, assets that generate wonderful cash flows over the long term with great contracts, long-term contracts in a lot of cases. Other cases, they're locally regulated monopolies, so competition really doesn't even exist for a lot of these entities. They have a lot of things that are built in that I'm going to show that help offset things like inflation, have it really well protected for things like rising interest rates. Let's take a look at the recent performance, though. I'm going to take a look at a slide here from the company's most recent investor presentation. And what do you see? Funds from operation increased in 2022, 11% year over year. Now, you adjust out from some gains from last year, some one-time gains in 2021, and it's a 20% funds from operation increase. This is a company, again, that does a wonderful job of not just reallocating capital. So this asset allocation, this 10% FFO growth over here, that is from assets that it's acquired, okay? The organic growth, again, this is from the core assets that it already owns. So what they do that they're really good at is they find these assets, they acquire them at a low multiple, and they look for assets with certain thresholds about ability to grow cash flows over time because of secular trends, demand for whatever that asset generates. Maybe it's a water system, telecommunications infrastructure, natural gas, power transmission, things like that. So they're really good at finding those assets, paying a fair price, and then selling those assets off over time. Here's a look at a couple of recent acquisitions that they've made. Made 5 pretty significant acquisitions so far this year, invest almost $3 billion. Again, you seek the kinds of things that they look at acquiring or things that generate steady cash flows, relatively resistant to things like in recession, and then they improve them. They spend money on those assets to help them grow their cash flows over time. Once they get to kind of a critical mass, they sell them off. They have a really good history of selling them off at a great premium. You look at the New Zealand Telecom Towers deal that they sold at a 34 times EBITDA multiple. That is a substantial premium of what they likely paid for those assets. And you look at the multiple on capital that they earned for these other assets, tripling the capital and the internal rate of returns that they get on those assets. They're really good at selling stuff after they've improved it and it no longer meets their threshold for growth capacity going forward. These guys are also fantastic at finding new and novel ways to invest. Recently transitioned into data center investing, looking at technology, found the opportunity through Brookfield Asset Management, its parent company, and then filtering down to the other entities. They're making a $500 million investment in Intel's Ohio semiconductor factory that's going to be built. The entire Brookfield entity is going to own about half of that facility. Brookfield Infrastructure is going to have an economic interest in it as well. It's just wonderful how good they are at finding these opportunities, getting deals that at multiples that make sense, paying it, owning those assets for the long term, and benefiting from the cash flows growth of those assets over time. I want to talk a little bit more about how that legacy applies going forward. Right now, the big buzzwords are inflation, rising interest rates. Those are things that have investors concerned about investing in equity stakes and taking ownership stakes in businesses. So first of all, let's talk about inflation. While a lot of businesses, inflation is a pain point, inflation actually can be a tailwind for the folks at Brookfield Infrastructure. 70 to 75% of earnings before interest, tax, depreciation, and amortization, also known as EBITDA, is directly linked to inflation. So as inflation rises, it triggers some levers to raise the prices with a lot of the assets and the cash flows that they generate. And then the 10 to 15% from fee for service models that, again, also raise up. So you're looking at 85% of the revenues, the cash flows from its businesses, not just protected from inflation, but benefit from inflation. There's a long-term history of capturing that inflation in FFO. So that's, again, when you can take inflation, you can make it something that boosts your business. I think that's absolutely wonderful. You're worried about debt, you're worried about rising interest rates. As a starting point, investment grade credit, $3 billion in corporate liquidity, and a substantial margin of safety in the payout ratio, the percentage of funds from operation that they pay out in distributions to investors. So there's 30% of it that's still left after dividends have been paid. Long-term debt that's fixed rate, you're looking at 90% of it. That is a substantial amount of its debt. Again, you look even further, 13-year average maturity on its corporate debt, 7-year average maturity on its non-recourse debt. That means the debt is relatively stable and safe, right? That's really, really important. I have one more slide here that I want to share, again, because this gets back to the company's culture, its long-term track record, and that's the thing, again, that I think is going to help it continue going forward, is this ability to invest across the cycle. Contracted cash flows that are well protected from things like inflation, things like rising interest rates, foreign exchange denominated. Most of their cash flows are denominated in US dollars, right? Little things like that are super duper important. And again, you think about the secular trends for investing in infrastructure around the world, whether it's modernization in the West or it's the need to develop new assets in developing markets. Brookfield Infrastructure sits right in the middle of that, with Brookfield Asset Management, its parent company, the top of the filter where the capital's coming in, finding the opportunities, and then Brookfield Infrastructure's management deploying that capital over time to grow cash flows, to grow funds from operations per share, and to deliver wonderful economic returns for investors. At recent prices, using dividend yield as a proxy for valuation, the dividend yield's about 3.9%. Then that dividend grows pretty consistently just about every year. I think Brookfield Infrastructure is a reasonable valuation right now. It is October 31st, going to report earnings on the 2nd. There's probably going to be some volatility. So whether you're watching this before earnings or after earnings has already happened, remember, there's always going to be more volatility this time of the year around those quarterly earnings periods. Keep that in mind. But I do think that investors that buy this stock today and hold it for 5+ years are going to be very, very satisfied with the results that it generates and be glad that they owned it.